Hey, good morning, everybody, and welcome to a special webinar with Mitch Kider. We just concluded our Tuesday sales call. My name is Dave Savage. I'm the CEO of Mortgage Coach. I urge you guys, everybody on this call, many of you are customers and friends, connect with me on LinkedIn, Facebook. I want to remind anybody who's not on our team, we're a very values-driven organization. From the day we founded the company, it's all about wowing people, surpassing expectations. We've always done that through education. We've always just believed the best salespeople are teachers. They're teaching people things that they didn't know, and we're doing it at a level of excellence. So the mission we have at Mortgage Coach, it's been the same really since we started the company. It's to help make sure every borrower makes a confident mortgage decision that aligns with their financial goals, and they do it in a manner that they actually understand. So, we've been fighting for total cost for, 15 years. We've had the total cost of a loan over 5 years, and now it's a compliance requirement. So it's good times at Mortgage Coach. I want to bring in our president, Joe Patur. We're both going to interview Mitch together. Joe runs the Mortgage Coach product. So, Joe, welcome to the call.
Hey, Dave. Thanks for having me, and thanks for everyone from the community, from so many thousands of lenders who have registered and joined today's conversation. Dave, I do want to take just a moment and just emphasize to everyone on the line, there are many, many leaders here who haven't really realized just how much mobile innovation is now available here at Mortgage Coach as part of their membership. One of the most exciting things that I know many folks have been talking about is the new Apple Watch. And so I think it's important to just introduce everyone to the Rate Watch experience that's available now on your wrist on this device. And so if you are one of the few folks who have a brand new Apple Watch, pull it out of the box and make Rate Watch one of the first apps you download. And if you don't have one of those devices yet, of course, most of us do not, go ahead and install Rate Watch on your smartphone, whether it's a Google device or a iOS device or even a Windows device. You can go ahead and install Rate Watch and go ahead and just use your Mortgage Coach credentials, and you'll start getting great content instantaneously to the device. I also think it's really important as we talk about some of this compliance information, all of you know how pivotal it is to inform your consumers, the families, the realtors and partners of updates and changes in real time as quickly as possible, and video and audio communication really help deliver that capability. And so with the new update in the Mortgage Coach app, you can now narrate your presentations from your device. You don't have to only use your webcam on your PC. So you can narrate the presentation now from the device. You can also drive a live experience. So you can highlight the graphs and the charts much like you have done on the desktop. So you'll see that update coming out throughout the month, and many of you are on the early release for that. So thanks so much to the community for helping all of us be mobile innovators. As you know, we've been innovating a lot to meet the compliance guidelines of TRID, and we're really excited to be a fundamental strategy for many of your lending organizations. And today, Mitch is going to answer some of the most important questions to turn TRID into a competitive advantage. So with that, Mitch, help us make the best of TRID.
Absolutely.
So Mitch, welcome to the call.
Thank you. Good to be here with you guys.
Good. Well, about 1 more minute of just setting the table for Mitch, and then we'll start asking questions. We've been pushing this message around you need a compliance strategy. What's your strategy? And as I was preparing for this call, it really hit me last week. We don't need a strategy. We need a compliance transformed company. And that term hit me when I was actually on DC last week, and I went and met with the Rick Edelman team. I mean, he's the nation's #1 financial advisor. He's got about 120 actual financial advisors that work for him. And when I was walking around his office and meeting with his team, this was a picture I took, where they, on the desk, this was the only thing that was uniformed on every desk where it said, think compliance first. And I just, I couldn't help but think, what a great setup for today's call. Because this is what we need to do as an industry. We need to become, compliance transformed lenders. This document, it had media, personal training, reminders, gifts. So the push and the goal with this call is that we want to make sure that loan officers, branch managers, heads of production, the people that are our customers, they understand TRID. First of all, I think we've all gone through about 5 names. Is it TILA RESPA? Is it integrated disclosures? Is it know before you own? Well, the term is TRID. And I think the thing, Mitch, as you answer these questions, try to keep in mind that, you're not just talking to the C-suite. While there's some CEOs on the call, we're talking to loan officers. And I do believe, at least the training and the MBA events I've gone to, most of the focus is on, disclosure. It's not around what's the cost over 5 years. It's not how TIP is going to impact things. So, Mitch, just keep in mind, everybody on this call has one thing in common. They're either our customer, and they believe in going from price to advice, or they're our friends. And we've been pushing this message for 15 years that every time someone gets into debt, they should have options, and they should know the cost over time. So that's a common thread with everybody on the call, Mitch. And with that said, I'll let Joe Patur kick it off with the first question.
Well, Mitch, how grateful everyone from our community always is for your advice. So with that, many lenders here on the phone have been getting misleading information. There's a lot of emails being blasted out, and many of them describe what TRID is, but most don't talk about what it is not. So maybe you can provide some framing on what everyone should be thinking about today.
All right. So thanks, guys. So TRID basically is a disclosure rule. That's what it is. It's intended to make it easier for the consumers to use disclosures as opposed to using the GFE and the initial truth in lending. Now it's all going to be in one form. It's going to be in the loan estimate itself. When they go to closing, instead of getting a final truth in lending statement and instead of getting a HUD-1 settlement statement, they're going to get a closing disclosure. So theoretically, it's all going to be much more consistent and much more understandable for the consumer. It's going to improve the consumer's understanding of their specific loan terms. It's going to help them compare what they're getting with what is otherwise out there. And probably most importantly from the CFPB and the consumer's perspective and from our perspective is it's going to prevent surprises at the closing table. So it's a disclosure rule. That's what it is. It's a rule that basically tells you how you're going to disclose certain information to the consumer from the point of time before you have an application on your hands and all the way through closing itself, and sometimes beyond the closing itself when you still have to make corrections on the closing disclosure. It's not as different as people think. The structure is pretty similar to what we have today. The details and the nuances are a little different. There's a lot more to it. But basically, to a large extent, it integrates, it incorporates, and it clearly defines many of the same types of requirements that actually are in place today. So that's basically what TRID is. It's important. It is a dramatic change because they are different forms that are going to be used. There's a little bit of a change in philosophy over here, as opposed to disclosing bundled fees as we do on the GFE and the HUD-1. We're going to have to itemize fees separately. Instead of having line numbers, we're going to itemize our fees alphabetically so that the consumer has a better way to take a look at what they have in front of them. The next thing that I will say, and we'll talk about this a little later on in the process, is it's a process-driven rule. It sets out the requirements that govern and that restrict how lenders and, more importantly, how their originators can originate loans from the pre-application process all the way through post-closing activities. That's really what TRID is all about.
Well, I think that really gives a very focused perspective on what it is and what it is not. But when you look at what lenders have to do now that is available and that insight is here, what should the first thing that they look at be in terms of changes to their processes internally?
Well, when you talk about the first thing that they should look at is they need to know and understand what the rule is and how the rule is basically going to affect them. There are a number of definitional issues in this particular rule. For example, the date on which you conduct business. A business day is defined differently. In some cases, you have a general definition for it, which is any day that you're open for business. In some cases, you have a specific business day, which is every day except for Sunday and 10 federal holidays that are specified, and it governs certain requirements and timing requirements itself. So what should they look at first? They should look at the timing requirements and know and understand when they have an application on their hands, so they know and understand what that triggers. Triggers a number of things. It triggers the loan estimate being given. It triggers the list of settlement providers. It triggers the settlement service booklet itself. What they need to do to prepare for these things is, number one, get a better understanding of what's required of them through this process itself. Number two, identify the policies, the procedures, and the practices that, in fact, do need to be changed. Remember, at the end of the day, prior to closing, now a consumer needs to get the closing disclosure at least 3 business days before the closing actually takes place, before consummation of the loan transaction. And that's obviously going to be very important, and it's going to have some implications for the timeliness of closings.
So Mitch, you mentioned earlier that it's a process-driven rule. What are some of the key processes that are going to have the most impact on loan officers? Think about it from a sales perspective.
Well, it's definitely a process-driven rule. It dictates just about everything that you are going to be able to do in terms of what you tell the consumer and how you deal with your borrower throughout the origination process itself. So it all starts with an application, and there's a definition for an application. It's the old RESPA definition of an application. There are 3 things. It's the name, the income, the social security number, the property address, the estimated property value, and the loan amount that's sought. So number one, the loan officer needs to know and understand that once you have that information, once that has been given to you in anticipation of getting credit, you have 3 days in which to get 3 things out. Number one is the loan estimate. Number 2, as I said, is the list of service providers. And number 3 is the settlement service booklet. That's one thing that they need to know. Let's take it one step backwards. They need to know that prior to that point in time, there are certain restrictions on what they can do. Pre-disclosure activity. You cannot ask the consumer to provide you with verifying and supporting information concerning the very items that I just went over. So obviously that's a very important thing, and that's a process-driven rule. Now once that disclosure is given, well, let's talk about the disclosure itself. It's process-driven. Now good faith effectively means that you have met a good faith requirement. You have to give a good faith estimate of the closing costs, and you met that requirement when you get it right. It's very interesting. So much for good faith. You have to be exact. You're almost giving a guarantee. There are a few exceptions that come into play over there. There are exceptions if something fits within a specific tolerance category, and we can go through what some of those tolerances are. And there are exceptions when you're permitted to, in fact, issue a revised loan estimate. Again, process-driven. When can you give a revised loan estimate? And loan officers need to know and understand that. It's not all that different than when you would give a revised good faith estimate today. You're going to do it when there's a changed circumstance. That's number one. You're going to do it if the consumer requests some kind of change that will impact the fees or the rate itself. You're going to do it when the loan estimate expires, and that's process-driven as well. Once you give the loan estimate, you must keep it open for a period of 10 days so the consumer can think about whether or not they want to proceed with this transaction, and so they have time to, in fact, go out there and shop around. So it's process-driven in terms of you're not moving forward, not collecting fees if, in fact, you haven't gotten an indication from the consumer yet that they intend to proceed. You can make changes again if there's delayed settlement on construction for new construction, process-driven again. Rate-dependent changes, when they lock in, you have to give a new loan estimate, process-driven again. It dictates, this rule dictates each and every step that you go along in the process of originating the loan by way of communicating with your borrower.
So communication is king, process is king, accuracy is critical, and we don't want to wait until August to get there. So a couple things, everybody. I mean, this is one call we're doing with Mitch. We may be doing more calls like this If you do have questions, please put those in the GoToMeeting question section. We do have a pretty stacked deck today, but we'll be looking for your questions. If we have time, we'll bring it into today's conversation or future conversations. So thinking of, the loan officer and the salesperson, and we all know whether you want to call it a pre-qual, a TBD, a pre-approval, some things are going to change. So if you could, one, answer that for the loan officer, and then I think it's important that we teach loan officers how to be great leaders to realtors and set better expectations. So if you could kind of hit this twice, Mitch, what are pre-approvals from a loan officer's perspective, and what should they be telling realtors to set expectations?
All right, so let's talk about pre-approvals for a minute, because there's been a lot of conversation out there about pre-approvals and the fact that loan officers may not be able to do pre-approvals because they can't get information that they need to get a pre-approval done and things of that sort. You spoke earlier about misinformation. There's a lot of misinformation going on, especially around this particular issue. The truth of the matter is the requirement that's out there for pre-approvals is no different than the requirement that's in the rule that we're dealing with today for the good faith estimate. The rule that's in place today, Reg X of RESPA, specifically says it prohibits the lender from requiring as a condition for providing a GFE supporting or supplemental documentation to verify the information itself. So it exists today as well. Now what the CFPB has done is they've incorporated what already exists and they've clarified the restriction itself. You cannot require a consumer to submit documents verifying information collected for an application before you provide the loan estimate itself. Does that mean that you're not able to ask for information in order to do a pre-approval? No, it doesn't mean that at all. It means that, in fact, the consumer can voluntarily give you that information. You can suggest to a consumer that it might be easier, in fact, in the pre-approval process if they provide you with that information, as long as you tell them that it's got to be voluntary. You can't require it. Can you go out there and verify information yourself? Because a pre-approval is basically an approval with very limited conditions. It's an approval on something where you don't have that property address typically, and the conditions you place on it are very, very limited. And so you've underwritten that loan and you said, okay, you can be approved, you will be approved subject to the following limited set of conditions itself. So of course you're going to need to go out there and verify information. You can verify that information yourself. You can't ask the consumer, you can't require that the consumer bring that information to you. So can you say to the consumer, bring me your bank statements, bring me your pay stubs? No. The answer is no to that. Can you go forward and start the verification process along those particular lines? Yes. The purpose here, the purpose of this particular provision that says that you can't require the consumer to bring you documentation and specific supporting and verifying information prior to the loan estimate being given, the purpose is to prevent burdening the consumer. It's to avoid overburdensome documentation demand on applicants and really to give them time to facilitate shopping so they can compare and they can in fact go ahead and look around. So the CFPB themselves has said that this particular rule is not going to affect pre-approvals as long as the consumer is not required to provide verifying documentation themselves. But they can provide documentation voluntarily. Obviously, they can go ahead along those particular lines. You can't condition the ability to submit an application on completion of the pre-approval process. But many times, for a variety of different reasons, the consumer doesn't have an address yet, and they need that pre-approval so they know what they otherwise get, or a seller may in fact look at them and say, listen, until I know that you have been pre-approved, I'm not going through with this particular deal. I'm not going to contract that. So voluntarily, can they give you specific documentation themselves? Yes. Can you otherwise go ahead in the process and verify the documentation for a real pre-approval? Absolutely. We're not talking about a pre-qualification, which has a completely different meaning, and which has many, many, many more conditions that are applicable to it. But a HMDA pre-approval itself is something that you're bound by as long as they otherwise go forward and meet the conditions that you set out for them. And yes, the process isn't going to be any different than it is today.
I think other than the fact that we're going to have to be more careful with our words, because I think loan officers, and legally there's a big difference between a pre-qual and a pre-approval, but as an industry, you talk to 10 different loan officers, you get 10 different answers. So one last thought before we move off this question: what should loan officers be telling realtors so that they're setting expectations? One, they're being leaders today, and two, they're setting expectations with their agents so that it goes smooth. I mean, you've seen some of the news where they're telling realtors there's going to be 15-day delays in closing. That doesn't pertain to this, but what is your leadership there?
Yeah, well, there aren't going to be 15-day delays in closing unless someone has done something wrong in the process itself. It really shouldn't be that bad. The truth of the matter is that loan officers now are going to have to be much more hands-on with their partners, with realtors and with other partners in the transaction itself, and with the consumer, quite frankly. They're going to have to communicate and constantly communicate and let them know where they are in the process itself, so they know what the expectation is, and so that they can collectively, with the real estate agents, manage the borrower's expectations. So what do the real estate agents need to know? Well, they need to know what the time requirements are from the beginning to the end. They need to know about the 3 business day requirement once you have the application, so they know and understand when the consumer, in fact, is given a loan estimate. Why is that important? Because the consumer has those 10 days before they have to tell you that they have an intent to proceed. But obviously, they can tell you that earlier as well. So real estate agents need to understand that 10-day period of time. That could cause delay in the process if in fact the consumer or the applicant sits on that for the full 10-day period before you go forward and are able to, in fact, collect your fees and start the actual process of getting approval for this particular loan transaction. So the intent to proceed 10-day requirement is very, very important. What else is important? What scares real estate agents and what scares home builders and others along those particular lines? It's missing the closing date, missing the date of consummation, especially if those dates are set out in the contract itself. And so what do they need to know about that? They need to know the requirement that a closing disclosure be given to the consumer, provided to the consumer, 3 business days before closing. That's important because at least early on in this particular process, as this rule comes into effect in August, there are going to be some mishaps. There are going to be some times when, in fact, you're going to miss a closing date. You ought not miss very many of them, quite frankly, as long as you prepare in advance, as long as your company really is on the ball on this particular issue. But there may be some over there, and realtors need to understand that. So the most important thing they really need to know is the timing requirements, the fact that they need to assist. They need to help you manage the borrower's expectations. That's very, very important. And in terms of pre-approvals, I mean, many realtors today, many real estate agents today say, I'm happy to help you look for a house, but I want to see a pre-approval. Depending on which market they're in, but many real estate agents do that. And you need to understand what we just went through. You need to make them understand that particular process. You need to let them know that you can't require that that borrower give you that supporting information, give you that verifying information, but in fact, you can let the borrower know that they can voluntarily do it. That will help the process move along quicker along those particular lines. So it's all about communicating, educating, and managing the borrower's expectations.
Got it. Got it. So you might have answered this question to some extent, but I'll go ahead and let Joe put some color around it.
Well, no, I really do think Mitch did a great job of breaking down what to set the expectation with realtors with. But we can't have a conversation like this without at least briefly talking about MSAs. So many folks on the line are lenders that find their relationships with realtors pivotal to production. They're purchase agents. They drive a lot of the bottom line. And so, putting acronyms aside, what's your take on how do they maintain these relationships, and what does it mean when there really is no enforcement around these relationships today?
Well, I guess I would start off by saying the obvious, and that is that the CFPB's approach to MSAs is inherently inconsistent. There is not a lot of enforcement out there, but every once in a while you see a consent order come out. So we're all familiar with the Lighthouse consent order. We're all familiar with what the CFPB said in Lighthouse. They set out certain standards for an MSA, and they basically said you better have a third party verify that the services really are worth what you're paying them for it. You better monitor and audit that the services were done, preferably before you make any payments to your MSA partner. The marketing services should be general, should reach the general public, and should not just be geared to specific consumers themselves. But then they went forward. They went further and they said, but you know what, if you have a referral arrangement and you have an MSA, you might have a problem on your hands, or you do have a problem on your hands, because the contract with a realtor or a home builder or a third party to provide those marketing services, that alone is a thing of value. And so if you're giving them a thing of value and you have a referral arrangement, there's an understanding that they're going to refer business to you, then you might have a RESPA Section 8 problem itself. Now, the CFPB, from a legal perspective, is wrong in their reading. It's inconsistent with the regulation itself. That is not what the regulation says. The regulation, in fact, says referrals are not compensable except under the following circumstances, and then lists what Section 8C2 of RESPA says, and that is that you can pay bona fide compensation or the reasonable value for goods or facilities that are otherwise provided. So the CFPB is wrong in their approach, but nonetheless it is their approach to Section 8 of RESPA, not just MSAs itself. That is where they are today. Will that change? Hopefully that will change when they take a strong look at their own regulations, which they adopted. This wasn't just left over from HUD itself. They adopted that particular regulation X as well. So that's where we are with MSAs, and there is a lack of enforcement activity that's going on. But, I think that's largely a function of numbers. There's just so much staff out there. Yesterday I read an article that the CFPB and their investigations are backlogged. And so some things are just standing still along those particular lines. So MSAs are, it's the question that never goes away. Do I do an MSA? Do I not do an MSA? And it's obviously important to loan officers and to lenders because it's assisting them with their relationship with certain realtors and real estate agents. And it's clearly important to real estate brokers, because more and more they rely on what I call this ancillary income, money coming in from other sources.
Well, and so much of the misinformation that's available in the market today leads many lenders to wonder if they can have a relationship with a realtor. And I think that's part of the real misunderstanding is it is an important relationship to maintain. You just have to maintain it the right way.
Well, that's exactly right. And now when you talk about TRID, you better have an even stronger relationship with a realtor, because the realtor has certain expectations. They want that loan to close because they want that sale to go through, and they want that to be done on a timely basis. But they're not the only ones that want it. Their consumer wants it. Their consumer really needs it. Their client absolutely needs that. So your relationship with a realtor has to be even closer today. Or starting August 1st. You're going to need to be able to communicate with them on a fairly regular basis, as I said before, because you both collectively are going to have to manage that consumer's expectations.
Yeah, well, it represents a great opportunity to just get better, build better relationships, build better processes. I do want to thank Rob Chrisman for this question. This came from Rob. Also want to do a shout out and thank Sarah Middleton with Fairway on the push to ask questions that would help loan officers provide better leadership to realtors. So Sarah, thank you for that. And again, anybody on this call, if you have questions that you want us to ask, Mitch, whether it's on this call or future calls, put that into the GoToWebinar control panel. So, you know, we've got mortgage coach loan officers, mortgage coach leaders on this call, and we get asked this question a lot, but what are some of the considerations for pre-disclosures, like our total cost analysis? You know, what can loan officers provide to borrowers? What do they need to stop doing? And I know I'm just piling on the questions, get to it as you go, but what about rate quoting with emails? So how do you answer that, Mitch?
All right, so let's take it from the top. In terms of what you do pre-disclosure, in other words, pre-loan estimate itself, can you give a cost estimate, which includes, you know, an estimate of what their rate will otherwise be? The answer to that is yes, you can do that. And this rule actually clarifies how you do that. You have to make sure that the manner in which you're doing it and that the documentation you provide does not in any way, shape, or form look like the loan estimate, like the official form, and it does not look like the closing estimate. You have to have different headings. You have to use a different format that was in the that are in the LE, the loan estimate, and the CD, the closing disclosure itself. You also now have to have a very specific disclosure, and it's so specific that it has to be in 12-point font, and it's a disclaimer that has to be on the top of what you provide, and it's got to say your actual rate, payment, and costs could be higher. Get an official loan estimate before choosing a loan. So that has to be provided along with any of these cost estimates pre-disclosure that you provide, and that's a brand new requirement that's there. It doesn't apply to general advertisements, but it applies to estimates that are specific to the consumer themselves. The CFPB really wants you to ensure that these costs estimates, these pre-disclosure, pre-LE cost estimates, which may provide unreliable information, are clearly distinguishable from the loan estimate, which is subject to this good faith requirement, which, as I said earlier, is virtually a guarantee. That's what the good faith requirement is. They want to make sure that the consumer knows the difference and that you tell the consumer, hey, this may not be what you ultimately get. This may not be accurate. So they also want to make sure that none of the loan officers out there are playing games. If the consumer wants to submit those 6 pieces of information to you, you got to take those 6 pieces of information. You can sequence it in terms of what you ask for, but you can't turn them down if they're giving you that information. And once you have the 6 pieces of information that constitute an application for loan estimate purposes, then all these pre-disclosure estimates really go out the window. You have to give the loan estimate itself. So for any cost estimates or rate quotes, including emails, you've got to ensure that your activities are in compliance with these pre-disclosure restrictions that I just laid out for you. You have to balance accuracy with consumer service, obviously, and you got to train and monitor. You got to monitor the transactions, the conversations, and activity so that you can protect yourself along those lines. Lenders have to make sure that it's going well. Quite frankly, it makes what you guys do at Mortgage Coach all the more important. It absolutely does. Consistency is very important, and staying within the 4 corners of this particular rule on pre-disclosure activity, what you can say, what you must say, and what you can't say is absolutely essential.
So quoting rates in an email, good idea, bad idea?
Well, quoting rates in an email is, it's certainly not my favorite thing to do, quite frankly. But you can go ahead and do these things, but remember the disclosure that you've got to lay out for them. In fact, if you're going to give them any type of a cost estimate, including rates, you better have this specific disclosure over here that says to them, this might not be what you ultimately get. Your actual rate, payment, and costs could be higher. Get an official loan estimate before choosing a loan. You have to make sure that's in there. And if you're going to quote rates in an email, that's going to have to be in your email as well.
Yeah, and it's hard to manage it. So again, we're dedicated to that, to make sure that you can quote the rate, APR's there, and it's in a way that can be audited. So that's Joe, anything you want to add to that, or any color you want to provide on that specific question?
No, I would just say thanks, Mitch, again, for framing the information as clearly as you have in the event. I think that for many folks, and I can see in the chat and I can see in the feedback, we're addressing some of the most important questions. And I think this lays great foundation for just, on the documents themselves, they now mention the total cost over time. And Dave and myself have been educating the market on just how important understanding total cost is. And so maybe you can give your perspective on why they've decided and really what it means to have total cost now as part of the conversation.
Well, I actually think total cost is great. I know you guys have pushed this for a long time. I'm glad to see that the CFPB has adopted it in this particular rule. And we're talking about, in your loan estimate, providing total cost over the first 5 years of the loan itself. So what are you going to provide? You're going to say in 5 years, you're going to tell them how much they will have paid in interest, in principal, interest, mortgage insurance, and loan costs, and what principal otherwise will have been paid off. Your costs over the term of 5 years expressed by way of a rate itself and an APR itself. I mean, the current TILA disclosures today focus on the costs of credit based on the loan's contractual terms. So you're talking about the cost of credit over 30 years or the cost of credit over a 15-year period of time. But the reality is the vast, vast, vast majority of borrowers out there, in fact, either pay off their loan, move, refinance, or do something else along those lines within a 5 to 7 year period of time. And that's what the CFPB acknowledged. That's what they recognize in this particular rule. And so they modified the existing truth in lending total payments and disclosure to reflect the total payments over a 5 year period of time rather than the life of the loan on the loan estimate, okay? So that the consumer has a much better understanding of what this loan is going to cost them. Now, on the closing disclosure, you are going to disclose it for the life of the loan itself, for the contractual term of the loan itself. So that's still going to be there and available for the consumer. But on the loan estimate, it actually makes all the sense in the world to give them the total cost of the loan for a 5 year period of time and to include all of the things that I laid out for you. The principal, the interest, the mortgage insurance, the loan costs, and the principal that will have been paid out, amortized out, during that 5 year period of time or at the end of that 5 year period of time. This is, I think, an incredibly helpful tool to the consumer, much more helpful than just giving them this information or some semblance of this information over the contractual term of the loan.
Well, I think for the folks who are on the phone and listening today, I think that the message that you just shared is really clear in laying out why the total cost is an important part of the conversation. For anyone on the line today who doesn't know the best methodology or how to lay out the total cost over time in a way that's very clear, please post the questions, and our team and many of you, our members, our support organization, will also address those questions. But speaking of showing cost over time, cost is an important part of that dialogue, and one of the questions that came up a lot were around the fees that can be collected in the beginning of the conversation. So while we all advocate the long-term costs and advantages that need to be understood by the customer, everyone on the line here is running a business. And so they're traditionally been able to collect something up front from the borrowers themselves. So what are your thoughts on what's okay and what's not?
So there is something that they can collect from the borrower themselves up front, and that is a bona fide and reasonable credit report fee if, in fact, you're going to run credit. But that's it. It ends right there. No fee, no other fee can be imposed on the consumer in connection with that application before that consumer has both received the loan estimate and, second, indicated an intent to proceed with the loan that's described in that loan estimate itself. So until that point in time, until you get that indication of an intent to proceed from the borrower, the only thing that you can collect is a bona fide and reasonable credit report fee. Now, you might ask, then what is the intent to proceed? How do we know? Well, we know that silence is not sufficient. We know that you, as a lender, have to set some standards for how you're going to determine that you have the consumer's intent to proceed. A policy outlining what your loan officer or loan originators should get, what documentations, is what you absolutely need. Is it best to get something in writing? It's absolutely best to get something in writing. Does it have to be that way? No. It could be communicated to the loan officer. That communication should be documented by the loan officer, by the creditor itself. It might be that during the 10-day period of time, you explain to the consumer that, in fact, there's additional information to proceed with this loan transaction. Ask them for that information because you can after the loan estimate is given. And it might be that you use the fact that they continue to provide you with additional information and verifying information as an indication of their intent to proceed. But you need to let them know if, in fact, that's going to be your standard. So there are a number of different things you can do. But the point of the matter is, until they have gotten that loan estimate and until they have told you or you have that indication from them that they intend to proceed with that transaction, you're not collecting any fees other than that credit report fee.
Well, and I think that needs to be well understood because obviously that is one of the points where there is some misinformation going around the industry. So let's jump to the closing disclosure. And there's obviously the clear timeline that it needs to be provided by that 3-day period. But how early in the conversation can you provide it and ask for it to be signed?
You know, it's a good question. It's an interesting question, and I've heard a lot of people talking about, you know, possibly getting that closing disclosure out very early. The reality is, technically, there are no restrictions on how early in the process it can be provided. But the reality is, number one, you should not be giving that closing disclosure until you are confident that the amounts that you are putting in that closing disclosure are absolutely accurate, that they are accurate and they are correct. And number two, you have to remember that once you give that closing disclosure out, you cannot revise the loan estimate. So you can't revise that loan estimate after the closing disclosure has been provided. There's only one exception to that, and that is if the timing of a change that would cause you to issue a revised loan estimate, if it occurs less than 4 business days between the time of the revised change when it has to be disclosed and the consummation itself, then you can make that change in the closing disclosure. So that means for last-minute changes that would cause you to, in fact, give a new loan estimate, you have given the closing disclosure, you can, in fact, put that change in a new revised closing disclosure. But it's a very, very limited exception. So remember, the earlier you give that closing disclosure, you have locked yourself in to everything that is in that closing disclosure. And that's the issue that you have. That's what you have to balance out against this desire to just get it there very early so that you meet your closing on time.
Got it. So, I mean, I just want to make sure everybody connects the dot on this. So does that mean that they sign and we wait 3 days, or does it mean we close and they can't sign until after 3 days?
Well, I assume you're talking about signing the security instruments, the note. That's what you're talking about, signature? Yeah. All right. So that's a really good question as well, and there's a fair amount of confusion out there about that particular question, but it works this way. Number one, it's really a state law issue. It's a state law determines what is the actual consummation. When is a loan transaction consummated? But I will tell you, the majority of states out there say that consummation occurs when as a consumer, you're contractually obligated on the credit transaction. And what does that mean? When are you contractually obligated on the credit transaction? Well, I'll tell you, the Ninth Circuit Court of Appeals, which has jurisdiction over California and a number of other Western states, they tell you it's upon signature. Many states tell you it's upon signature itself. That is consummation. So the best practice, quite frankly, the best practice here to be safe across the board is to get that closing disclosure to them 3 business days before any of those documents are signed. The other point that you have to recognize about that is you're defeating the purpose of the rule if you have them sign documents that contractually binds them and, in fact, then give them the closing disclosure and wait 3 days until you fund. That's almost meaningless along those particular lines. So the real answer is you can't have them sign those the loan instrument, the security instrument, or the note until they have had that closing disclosure for a period of 3 business days.
Perfect. So again, I think it's always important, especially with loan officers, it's not only do they need to know the rules, they need to know the kind of the why behind it. So what are the primary reasons, a CD would have to be redisclosed and have to start the 3D clock all over again? Let's just help everybody understand the why.
Well, understand that there are a number of things that may change from the closing disclosure that you have given them, which you can change and still meet your closing date and make that change right up until the date of consummation itself. There are 3 things that you cannot do that for. The biggest concern over there is redisclosing the closing disclosure, giving a new closing disclosure and having to wait another 3-day period of time. And there are only 3 instances in which that occurs, in which you have to wait an additional 3 days. And that is, number 1, the APR is inaccurate. Inaccurate to the tune of 1/8 above or below on regular transactions, 1/4 on irregular transactions itself. But even then, that test is pretty nuanced, because if your APR is off because of finance charges, but your finance charges are otherwise deemed to be accurate. Now we're getting a little bit into the weeds over here, but your finance charges are otherwise deemed to be accurate. So in other words, your APR is off because your finance charges have been over-disclosed. Doesn't matter. Doesn't matter. You don't have to wait another 3 particular days. You under-disclose because your finance charges are off by more than $100, and that caused your APR to be off, then in fact you do have to. Less than $100, no, your finance charges are in fact considered to be accurate, and so you don't have to wait another 3 days. You'll redisclose, but you're not going to have to wait another period of another 3 days to in fact close the transaction itself. So that's number 1, the APR changes. Okay. Number 2, there's an addition of a prepayment penalty, which today you don't see very much, but that's okay. That's reason number 2. No. And number 3, there's a change in the loan product. You've gone from a fixed rate loan to an ARM loan. In fact, if that's happened, you're going to have to redisclose and wait an additional 3 days before the closing date. Those are the only 3 circumstances in which you have to wait an additional 3 days.
Got it. So not a lot of reasons.
No, it's actually not that bad, and when you look at what those 3 reasons are, it makes some sense, quite frankly. I mean, those are rather dramatic changes that a consumer, will want to take a look at. It goes well with the intent of the rule and what the rule is otherwise trying to do for the consumer.
Now, Mitch, going to the other side of redisclosing, if you identify that there was some sort of tolerance variation, can you just take an entirely new application, new documentation, and resubmit?
So the answer is no, you can't. If in fact you're going to close a loan based on the same terms that originally were applied for, the rule actually addresses this in the preamble. And the CFPB addresses this directly and states in the preamble to the rule that, in fact, you can't get away from your potential liability. You can't get away from what you originally disclosed to the consumer. You can't get away from your tolerance issue. If, in fact, they go ahead and reapply, or you deny them, they come back and they reapply with you, and it's for the very same transaction and under the same terms. You cannot do that.
And the term variation needs to be significant. Just changing slight loan amount and all those things
is not going to help you any. That's exactly right. It's not going to help you any. And a fair amount of denials and then new applications have occurred in the past, and it's clear that the CFPB was aware of that, or is aware of it now, and so they actually addressed it directly. It's in the preamble to the regulation. So that should not be an open issue any longer. The answer is no.
Very clear, very clear. And then how about on the subject matter of title insurance premiums and the whole idea of how you have to disclose this information in a whole new light?
So it's really interesting because even the CFPB acknowledges that what it's going to require come August 1st may not be in accordance with what a number of states require. But basically they said that doesn't matter. You're going to disclose it the way we want you to disclose it. And their big concern is when you have simultaneous rates and a consumer simply chooses to take a lender's policy and not an owner's policy, and then is suddenly surprised by how much that lender's policy is. So the CFPB is absolutely clear in how they want this to be disclosed. It's not the simultaneous rate, it is the lender's rate and it is the owner's policy, the incremental cost of the owner's policy. So what you do is you take what that simultaneous rate is, you subtract out the full lender's rate, and that will determine what the owner's rate is. So what you are disclosing from a title perspective is the full lender's rate. Even though it may be discounted in the simultaneous rate, that's irrelevant. They don't want that disclosed. They want the full lender's rate disclosed, and then you do the subtraction that I just said, and the incremental cost on the owner's policy, that's what you disclose for the owner's policy itself. That's what you reflect, that incremental cost on the owner's policy, but the full lender's policy, even though under a simultaneous rate, it may be discounted somewhat.
Well, that makes a lot of sense. So Mitch, we've had a fantastic hour and have covered a lot of content, and certainly we look forward to having another Q&A soon. As we think about TRID, is there anything that in this conversation that didn't come up that you think is really important for the audience here to know?
Well, I think that it all pretty much came up, but I think you have to sometimes take a step back and look at the overall picture. As I said, a lot of the structure is the same, but this is a much more nuanced rule. And you have to recognize that there's a lot to this particular rule. In some ways, it makes the process unduly complicated. Different definitions for business days, all kinds of different timing requirements, things along those particular lines. If loan officers are going to be providing loan estimates, they absolutely need to be on top of this particular issue. And it's going to be somewhat difficult at first. A number of companies out there, a number of companies are, I think correctly so, considering or have already determined that they're going to centralize their disclosures or regionalize their disclosures. Timing is everything. Loan officers are going to have to be all over this particular issue. They're going to have to get that information in even when they're not providing the disclosure to whoever is providing the disclosure immediately, instantly. because otherwise, if we don't know and understand what type of loan we're going to be giving out over here, that loan estimate is going to be absolutely useless to you, and yet you may well be bound by that loan estimate that was given. So that's really important. You have to take a big picture of it, and setting loan officers aside, addressing CEOs that may be on the line, I actually think it makes a lot of sense to consider centralized or regionalized disclosure. I think it's important to have that consistency. I think it's important from a quality control perspective, and I think you'll find a lot fewer problems on your hands.
Yeah, no doubt. We definitely align on that. So, Joe, go through the questions. Let's see if we can get one more question. I want to just tie this together for the Mortgage Coach leadership team because we have a lot of heads of production, branch managers, and then, Joe, let's see if we can close with one more question. So Mortgage Coach, everybody on this call, we've got to be more careful with how we're quoting pre-disclosures. So, our mission has always been to go from price to advice, to do that in a way that's consistent, not just for the loan officer, but for the branch and for the organization. We've always believed in the total cost over 5 years. To me, that's always made common sense that people don't know what APR means. They know what monthly payment is, and they know what cost over time is. So that's a great way to compare loans. And I do believe in a world of modern media where we can text, we can do now voice calls on our iPhones, we can leave a voice memo, and we can do video. So to be able to connect that and to be able to just deliver a better experience to families, that makes sense at Mortgage Coach. And so every time someone gets a loan, they have a loan officer. Let's face it, they've got a family member that's, a stakeholder they're getting advice from. If they're buying a home, they have a realtor. Depending on how they manage money, they have advisors. And at the end of the day, they're surrounded by people that are influencing the decision, asking questions. And so it's really important that we do it in a way that helps the realtor, because we're going to have to work better with that realtor than ever before. And let's face it, the genius father-in-law that, either costs the relationship, costs questions, we got to make sure that we proactively communicate with the people that care about the family that's buying a home. So part of our vision has always been to deliver that advice, do it in a digital way with a link, make sure there's a video or audio if the loan officer wants to add it. And again, Mitch, I don't know, are you going to be at the Optimal Blue event this year?
No, actually, my son's graduating law school on that day, so this year is the first year I'm going to miss it.
Well, we're going to miss you. That's where I think you and I talked about doing our first event like this.
That's right.
But I just want everybody, yeah, that's right, to know how easy Optimal Blue has made it to go from price to advice. I mean, literally, you can now click the Mortgage Coach tab. This can be activated for your Optimal Blue team. And now there's a Mortgage Coach button in Optimal Blue that allows you to go from here's my eligible pricing options to here's how to disclose it in a way that doesn't look like the fee disclosure remotely, in a way that helps you better communicate with both the realtor and the borrower, and to do it in a way where it's consistent and compliance can audit it. They can see, okay, we quoted this rate, and then something changed, we quoted that rate. So again, we're dedicated to help you guys deliver better advice. If you'd like to keep this conversation going with Joe and I, you can email me at Dave@MortgageCoach. While Joe asks the last question, I'm going to push a poll to everybody. Do let us know, do we crush it? Do we surpass your expectations on today's call? If you're a guest, you're not already a customer of ours, you want us to reach out and provide a demo, you can also click, I'd like to learn more about Mortgage Coach. So let us know how we did, and also let us know if you want to learn more. Joe,
so Dave,
Mitch,
Joe Owens, he asked from Gem that, he asked if the TRID rule has moved from RESPA and is now under TILA, is there any significance that you'd want to draw the attention to in that adjustment?
Sure. There's a lot of significance to the fact that it's moved to TILA because there is liability now for bad disclosures. Under RESPA, for an incorrect good faith estimate, or for bad closing disclosure or a HUD-1 settlement statement, there's no private right of action for those issues. Now you're under TILA. You've got statutory damages of $4,000. you've got actual damages, you've got the CFPB that can impose civil money penalties as well, as along with other remedies that are available to it under the Consumer Financial Protection Act itself. So there's a lot of significance to the fact that it's under TILA as well, and the reality is it's under TILA for those reasons, so that it now has teeth to it.
Well, thanks for the answer.
Well, guys,
Mitch.
let's and everybody, let's think compliance first. I think this leadership from the financial planning and the securities industry, where we think compliance first, I think every organization should put together, what are the things you want to teach your sales force? How do you want them to set expectations? How do you want them to communicate? What are those categories? I just put something together: advertising, rate quoting, personal development, realtors, and gifts. But everybody, you've got your culture. You've got, hopefully, Mitch Kider as your counsel. It's time to sharpen our swords. Again, reminder, this call is recorded. And also a reminder that these questions, we'll cut them up into little bite-sized pieces so that you can really understand what was presented. And as we wrap up today's call, I hope every loan officer will make compliance a priority. Go do a Google search. Go check out the CFPB website. You should learn this stuff firsthand. And Mitch, we're grateful for the time you took to prep. Connect with you. What's the best way for them to do that?
Well, they can email me at kider@thewbskfirm.com, or they can call me, 202-628-2000.
Good. Well, hey, thank you very much, Mitch, and we look forward to seeing you at an upcoming event. Maybe we'll see you at the secondary event. Joe, any last comments before we wrap it?
No, thank you to the community, and if anyone has any questions on how to download or enable any of the mobile applications that we covered, don't forget support@mortgagecoach.com is the simple way to email and get all your questions answered. So thanks again, everyone, for your time.
Take care, everybody. Thanks again, Mitch.
Yeah, my pleasure. Bye-bye.